assembled and in the meeting. I often find myself speaking at conferences just after the motivational speaker. And putting the wisdom of conference organizers' decision to put the economist after the motivational speaker aside, I can say I have benefited from the wisdom I have heard over the years. And one such speaker said to me that one needs to embrace their constraints. And I would say that our annual meeting committee really embraced the constraints of this meeting. One of those being, of course, that we are not together in person. And we took advantage of that by tapping a really star-studded group of speakers today. So first, of course, this morning, we're joined live by Chairman Powell, and he will be joining us from Washington, D.C., and we're so excited to have him back. Then Philip Lane, Chief Economist of the ECB, will be joining us from Frankfurt. And then later tonight, we will hear from Bank of Japan Governor Kuroda joining us from Tokyo. Before we get to our esteemed speaker this morning, we do have a few items to cover. And the first thing I want to do is acknowledge that we lost an important, beloved member of our community a few weeks ago, Frank Schott. Frank passed at the age of 94, and he was just a very beloved and dear friend to so many of us, and a real shining light in the Nave community. Frank was a longtime Nave leader, past president. He was a founding director of the Nave Foundation, as well as the chief economist of Equitable Life Insurance for many years. In his 1978 presidential address, Frank first articulated the need for a certification for business economists. And that is how the Certified Business Economist program was born. It finally came to fruition 35 years later, and Frank was a huge supporter of the CBE program. He personally evaluated all of our scholarship applications for more than a decade, including most recently this past August. Frank will be sorely missed, and the Nave Foundation will be raising funds for a lasting memorial scholarship in his name. I'd like to request a moment of silence for Frank. In a few moments, you will hear an update from Ellen Hughes-Cromwell, who is the chair of the Nave Foundation. And before Ellen gives her update on the Nave Foundation, I need to acknowledge that this will be Ellen's last meeting as Nave Foundation chair. We all owe Ellen a huge debt of gratitude for her work as chair over the past 2 years. The foundation's depth and breadth has grown dramatically with Ellen at the helm, including the Diversity Scholars Program. Now, this initiative dovetails with our commitment to bring more diversity to Nave by helping to address pipeline issues. Ellen, thank you so very much for your service. We do have a plaque for you that recognizes your outstanding work over the past 2 years. And normally we'd be standing on the stage, shaking hands, having a photo op. So this year, unfortunately, you're going to have to receive your plaque in the mail, which will be slightly less ceremonial, but no less heartfelt in terms of our gratitude. So now please tell us what is happening with the foundation and how we can help.
Thank you very much, Constance, and welcome everyone this morning. I'd like to give you just a very brief update on the Nave Foundation and you, the members who have contributed greatly to our success. First, before I do that, as Constance had thanked me on behalf of the entire board of the Nave Foundation, who have just been phenomenal, I also would like to thank our team, Tara Monroe, Michelle Ceresi, and of course, Tom Beers, who have been there every step of the way to grow our Nave Foundation and our contributions to business economics. Well, we have actually achieved this year 100% donations from all of our Nave board members and Nave Foundation board members. And we are now at the point of raising over $100,000 this year. We are looking forward to expanded donations. And it's not just because we want to expand our capability to grow. It's because we're giving life to many who are able to take advantage of our scholarship programs. One scholarship program I'd like to announce right now is the Diversity Scholars Program that we initiated this year. We had 20 diversity scholars at our economic measurement seminar. And I can't tell you the testimonials that we have gotten back from these students is incredible. I want to mention one thing that came through over 8 different testimonials. One issue came through. They talked about how the EMS helped to bring together data and what they are learning in the classroom, that it really gave them a sense of application of basic and important economic issues by using data appropriately and understanding where the data are developed. Here's one testimonial that really hit me. Personally, I took a leap forward as a business economist. Professionally, my team and clients stand to gain from everything I learned at EMS. None of this would have been possible without the scholarship. And then secondly, I want to mention that we are initiating a scholarship in Frank Schott's name. And that scholarship will essentially finance an applicant for the entire CBE program out through taking the final exam. We are so thrilled to have a scholarship in Frank's name, who worked tirelessly, as Constance mentioned, on the Nave Foundation. He's was an incredible leader. We owe him a debt of gratitude. And I think that announcing this scholarship program is just something that delights everyone, of course, on the Nave Foundation board, but more broadly, our Nave members. So where are we right now? We are asking you as NABE members to help us meet a $15,000 match for this meeting. And we'll be giving you updates over the course of the meeting, but please go to the NABE Foundation website. Please make a donation. If you want to donate specifically to the Frank Schott Scholarship, there's instructions on the website for you to do that. So I really hope that you take an opportunity to put another donation forward for the Nave Foundation. Finally, let me say it's been such a joy to be the chair of the Nave Foundation. I've loved every minute of it. I'm running to the tape. The tape is actually tomorrow, where I get to hand off the reins to LaVon Henry, who has been approved by our board to be the next chair, a 3-year term. LaVon is fantastic. He's really going to take the NABE Foundation and our scholarship programs to the next level. So thank you very much, Constance, for giving me the time to speak to the NABE members today.
Thank you so much, Ellen. And just as a reminder, you can donate via a link on the Pathable app. You can also donate at the NABE website to the foundation. And I know it's not the same as being in person, but our appeal is no more or no less rather heartfelt than it would be if we were in person. And we really appreciate any donation, no matter the size. It's really important to continue the amazing work that the foundation is doing. Now I'm going to introduce Lisa Emswo-Mattingly from Fidelity for our annual get-together with Fed Chair Jay Powell. This is the 3rd year that Lisa will be moderating Chair Powell, and we're so thrilled, Lisa, that you are able to do this again, and we just thank Chair Powell so much for joining us and kicking off the day 2 of our NABE 63rd annual meeting.
Thank you, Constance. Ellen and Constance, I will echo your thoughts about the great contributions from Frank. His legacy will live on in our organization for many years. I think very, very fondly of the times I've worked with Frank over the years. So Nave was formed in 1959 to be a forum for economists, many in the corporate sector, but also central banking and academia, to discuss the topics of the day. While the setting is very different than in those years past, it highlights that our organization's evolution continues to evolve. For example, our tech economist group now likely numbers as one of the largest groups within Nave. The Fed has also shown its ability to evolve, and their announcement, after much deliberation, discussion, research, and outreach of their new policy framework highlights this ability to evolve. Chair Powell took on the leadership at the Fed in 2018 after serving as a governor since 2012. Chairman Powell brings a broad range of experience to his stewardship of the Federal Reserve: lawyer, Treasury Department undersecretary, policy scholar, and capital market participant. This broad range of skills has helped Chairman Powell navigate some of the rockiest and most unprecedented events of the past century. Once again, it's a great pleasure to introduce Chairman Powell to our annual meeting. For participants that would like to ask a question, please enter them in the chat. I now turn you over to Jay, and thanks again for joining us.
Thank you, Lisa, and also Constance and Ellen. It's good to see all of you. Good morning. So it has been just 8 months since the pandemic first gained a foothold on our shores, bringing with it the sharpest downturn on record, as well as the most forceful policy response in living memory. Although it's too early for definitive conclusions, today I will offer a current assessment of the response to the economic fallout of this historic event and discuss the path ahead. As the coronavirus spread across the globe, the U.S. economy was in its 128th month of expansion, the longest in our recorded history, and was generally in a strong position. Moderate growth continued at a slightly above trend pace. Labor market conditions were strong across a range of measures. The unemployment rate was running at 50-year lows. PCE inflation was running just below our 2% target. The economy did face longer-term challenges, as all economies do. Labor force participation among people in their prime working years had been trending down since the turn of the millennium, and productivity gains during the expansion were disappointing. Income and wealth disparities had been growing for several decades. As the expansion continued, its long run, however, productivity started to pick up. The labor market strengthened, and the benefits of growth began to be more widely shared. In particular, improved labor market conditions during the past few years encouraged more prime-age workers to rejoin or remain in the labor force. Meanwhile, real wage gains for all workers picked up, especially for those in lower-paying jobs. Most economic forecasters expected the expansion and its benefits to continue, and with good reason. There was no economy-threatening asset bubble to pop, and no unsustainable boom to bust. While non-financial business leverage appeared to be elevated, leverage in the household sector was moderate. The banking system was strong, with robust levels of capital and liquidity. The COVID-19 recession was unusual in that it was not triggered by a buildup of financial or economic imbalances. Instead, the pandemic shock was essentially a case of a natural disaster hitting a healthy economy. Given the condition of the economy in the early stages of the crisis, it seemed plausible that, with a rapid, forceful, and sustained policy response, many sectors of the economy would be able to bounce back strongly once the virus was under control. That response would need to come from actions across all levels of government, from health and fiscal authorities and from the Federal Reserve. It also seemed likely that the sectors most affected by the pandemic, those relying on extensive in-person contact, would face a long and difficult path to recovery. These sectors and people working in them would likely need targeted and sustained policy support. Some asked what the Fed could do to address what was essentially a medical emergency. We identified 3 ways that our tools could help limit the economic damage from the pandemic. providing stability and relief during the acute phase of the crisis when much of the economy was shut down, vigorously supporting the expansion when it came, and doing what we could to limit longer-run damage to the productive capacity of the economy. When it became clear in late February that the disease was spreading worldwide, financial markets were roiled by a global flight to cash. By the end of the month, many important markets were faltering, raising the threat of a financial crisis that could exacerbate the economic fallout of the pandemic. Widespread economic shutdowns began in March, and in the United States, with many sectors shut down or operating well below capacity, real GDP fell 31% in the second quarter on an annualized basis. Employers slashed payrolls by 22 million, with those on temporary layoff rising by 17 million. Broader measures of labor force conditions, such as labor force participation and those working part-time for economic reasons, showed further damage. In response, we deployed the full range of tools at our disposal, cutting rates to their effective lower bound, conducting unprecedented quantities of asset purchases, and establishing a range of emergency lending facilities to restore market function and support the flow of credit to households, businesses, and state and local governments. We also implemented targeted and temporary measures to allow banks to better support their customers. The fiscal response was truly extraordinary. The unanimous passage of the CARES Act and 3 other bills passed with broad support in March and April established wide-ranging programs that are expected to provide roughly $3 trillion in economic support overall, by far the largest and most innovative fiscal response to an economic crisis since the Great Depression. What have these policies managed to accomplish so far? First, the substantial fiscal aid has given vital support to households. The rise in transfers supported necessary spending and contributed to a sharp increase in household saving. Goods consumption is now above its pre-pandemic level. Services consumption remains low, although it seems likely that much of this weakness is the byproduct of health concerns and social distancing, rather than reductions in income and wealth. Consumption held up well through August, after the expiration of expanded unemployment insurance benefits, indicating that savings from transfer payments continue to support economic activity. A recent Fed survey showed that households in July had surprisingly upbeat views of their current financial well-being, with 77% of adults either doing okay or living comfortably, an improvement even over the reading immediately preceding the pandemic. Still, since it appears that many will undergo extended periods of unemployment, there is likely to be a need for further support. Second, aid to firms, in particular the Paycheck Protection Program, and the general boost to aggregate demand have so far partly forestalled an expected wave of bankruptcies and lessened permanent layoffs. Business investment appears to be on a renewed upward trajectory, and new business formation similarly appears to be rebounding, pointing to some confidence in the path ahead. Third, after briefly seizing up in March, financial markets have largely returned to normal functioning, albeit in the context of extensive ongoing policy support. Financial conditions are highly accommodative, and credit is available on reasonable terms for many, though not all, households and businesses. Interest-sensitive spending has been relatively strong, as shown in the housing and auto sectors. Taken together, fiscal and monetary policy actions have so far supported a strong but incomplete recovery in demand and have, for now, substantially muted the normal recessionary dynamics that occur in a downturn. In a typical recession, there is a downward spiral in which layoffs lead to still lower demand and subsequent additional layoffs. This dynamic was disrupted by the infusion of funds to households and businesses. Prompt and forceful policy actions were also likely responsible for reducing risk aversion in financial markets and business decisions more broadly. While the combined effects of fiscal and monetary policy have also aided the solid recovery in the labor market so far, there's still a long way to go. Payrolls have now recovered roughly half of the 22 million decline, After rising to 14.7% in April, the unemployment rate is back to 7.9%, clearly a significant and rapid rebound. A broader measure that better captures current labor market conditions by adjusting for mistaken characterizations of job status and for the decline in labor force participation since February is running around 11%. The burdens of the downturn have not been evenly shared. The initial job losses fell heavily on lower wage workers in service industries facing the public, job categories in which minorities and women are overrepresented. In August, employment of those in the bottom quartile of the wage distribution was still 21% below its February level, while it was only 4% lower for other workers. Combined with the disproportionate effects of COVID on communities of color, and the overwhelming burden of childcare during quarantine and distance learning, which has fallen mostly on women, the pandemic is further widening divides in wealth and economic mobility. I'll turn now to the outlook. The recovery has progressed more quickly than generally expected, and the most recent projections by FOMC participants at our September meeting show the recovery continuing at a solid pace. The median participants saw unemployment declining to 4% and inflation reaching 2% by the end of 2023. Of course, the economy may perform better or worse than expected. The outlook remains highly uncertain, in part because it depends on controlling the spread and effects of the virus. There is a risk that the rapid initial gains from reopening may transition to a longer than expected slog back to full recovery as some segments struggle with the pandemic's continued fallout. The pace of economic improvement has moderated since the outside gains of May and June, as is evident in employment, income, and spending data. The increase in permanent job loss, as well as recent layoffs, are also notable. We should continue to do what we can to manage downside risks to the outlook. One such risk is that COVID-19 cases might again rise to levels that more significantly limit economic activity, not to mention the tragic effects on lives and well-being. Managing this risk as the expansion continues will require following medical experts' guidance, including using masks and social distancing measures. A second risk is that a prolonged slowing in the pace of improvement over time could trigger typical recessionary dynamics, as weakness feeds on weakness. A long period of unnecessarily slow progress could continue to exacerbate existing disparities in our economy. That would be tragic, especially in light of our country's progress on these issues in the years leading up to the pandemic. The expansion is still far from complete. At this early stage, I would argue that the risks of policy intervention are still asymmetric. Too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses. Over time, household insolvencies and business bankruptcies would rise, harming the productive capacity of the economy and holding back wage growth. By contrast, the risks of overdoing it seem, for now, to be smaller. Even if policy actions ultimately prove to be greater than needed, they will not go to waste. The recovery will be stronger and move faster if monetary policy and fiscal policy continue to work side by side to provide support to the economy until it is clearly out of the woods. Given this audience, I would be remiss were I not to mention our review of our monetary policy strategy, tools, and communications, which concluded recently with our adoption of a flexible average inflation targeting regime. My colleagues and I have discussed this new framework in detail in recent remarks. Today, I'll just note that the underlying structure of the economy changes over time, and that the FOMC's framework for conducting monetary policy must keep pace. The recent changes to our consensus statement reflect our evolving understanding of several important developments. There has been a decline in estimates of the potential or longer-run growth rate of the economy and in the general level of interest rates, presenting challenges for the ability of monetary policy to respond to a downturn. On a more positive note, we have seen that the economy can sustain historically high levels of employment, bringing significant societal benefits and without causing a troubling rise in inflation. The new consensus statement acknowledges these developments and makes appropriate changes in our monetary policy framework to position the FOMC to best achieve its statutory goals. The forward rate guidance adopted at our September meeting reflects our new consensus statement. The new guidance says that with inflation running persistently below our longer run 2% goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer term inflation expectations remain well anchored at 2%. The committee expects to maintain an accommodative stance of policy until these outcomes are achieved. The committee also left the target range for the federal funds rate unchanged at 0 to 0.25%, and it expects it will be appropriate to maintain this target range until labor market conditions have reached levels that are consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. We expect that the new framework and guidance will support our efforts in pursuit of a strong economic recovery. Thank you again. It's great to be back at Nave, and I look forward to our discussion.
Wonderful. Thank you, Chairman Powell. Lots to work on in our Q&A session, and I think I'll start with a question from the audience, which is about fiscal policy. And following the GFC, we had a significant tightening of fiscal policy, both at the federal level, but in particular at state and local levels. You mentioned this in your prepared remarks, but what would you hope to see in terms of fiscal policy in the next 6 to 12 months?
So, Lisa, I guess I would start by saying that the U.S. federal budget is on an unsustainable path, has been for some time, and I think that's something we will need to return to. And that just means having the economy grow faster than the debt. Having the debt grow faster than the economy is sort of by definition unsustainable in the long run. I would also say this is not the time to give priority to those concerns. The time to do that is when the economy is strong, unemployment is low, people are working, they're paying taxes, we're on sound fiscal and economic footing. That's the time to work on getting back on a sustainable path. You mentioned state and local government, and the same is true of the federal government. Policy was very tight, or conditions were very tight at state and local government because of the financial squeeze they were under during those years, and that held back the economy. There's research, a lot of research showing that. In addition, the federal government chose to cut spending and raise taxes long before the economy was close to fully recovered. And so I would just say that we will need to return to those concerns on financial sustainability. But I think in the near term, as I mentioned in my remarks, I think it's important that we keep working together. And in particular, I would point to one of the unusual characteristics of this downturn is how focused it is on a particular group of industries and people that are directly exposed to the pandemic. And these are people who their old jobs may struggle to come back to them because people will take their time in going back to certain activities that involve a lot of direct contact with other people. So I think the right thing to do and the smart thing to do for the long run is to continue to support those people as they return to their old jobs or find new jobs in different sectors of the economy. Great.
When you spoke to us in 2018, the Fed was just at the beginning of reevaluating their framework. And I've since learned that you are particularly keen of some of the estimates that you showed of how the Phillips curve and inflation trends had flattened over the past 2 decades. And those realizations helped inform the Fed's decision to engage in the average inflation targeting model. In the spirit of careful what you wish for, should we actually see some of those trends start to revert? Do you worry that it may actually be difficult to turn some of those trends back if they start to move upward?
Well, I guess I would say that the economy is ever changing. and the framework that we use has to adapt. It doesn't tend to change very quickly. It tends to change gradually over time. So if you go back to the 70s, what you had was a steep Phillips curve and also a high persistence of inflation. And those were the two of the charts that I showed. I think this was in Boston at your meeting there. And they really capture the change in inflation dynamics in our economy since that time. Of course, at that time, as the labor market tightened, you would see inflation move up. And when inflation moved up, people would expect, oh, inflation is going to be higher. And so it would be persistent.
Yeah.
Now the Phillips curve for a long time now has been pretty flat, and persistence is also quite low. So we need to take that into account. But we're not under any illusion that any of this is a permanent state of affairs. The economy will continue to evolve. We know that. And we know that we will have to keep adapting our framework as it does evolve. On inflation and the risk of something happening unexpectedly there, I think if you look around the world, what you see are disinflationary pressures from demographics, from technology, all over the world. And there's no question that can change, and ultimately, I suppose it will change, since nothing in this is permanent. But I would say that these have been persistent forces now. Disinflation, declining inflation, has been a persistent factor for some time. We are still seeing downward pressure on inflation, and I think it's appropriate for central banks, and certainly the Fed, to take that into account and move to a framework that is robust to that current situation, so that we're able to respond to future downturns.
Great. If we look back 10 years from now at the policy that has just been implemented, what would be signs of success?
Well, so as I mentioned, as we've gone through this, we had sort of three consecutive objectives, one of which was to provide stability and relief when the economy was closed down, and the second was to support the expansion when it came. Well, it's here, it's well along. And the third was to avoid longer run damage to the productive capacity of the economy. And that can come in two major ways, one of which is people being out of the labor force so long that they lose touch with their ability to participate in the economy. Their working lives and frankly their lives are disrupted in a very bad way. The other is just bankruptcies, unnecessary, inappropriate bankruptcies of particularly smaller businesses. There are always going to be bankruptcies and there's always going to be unemployment, but to have those go up to a high sustained level can do damage. So I would think the one thing I would look back on is how well we succeeded at that. And by the way, that is a lot of the urgency we've been feeling, is to do what we can as quickly as we can so that we can avoid those problems. And I think I mentioned temporary layoffs. So you see, when temporary layoffs have a way of dissipating either into permanent layoffs or into return to work, and that tends to happen fairly quickly. So it's now when we need to be working on that problem, because once you're permanently laid off, it's just more difficult. The data are really clear that it's just more difficult to get back in the workforce. So we want to help those people, as I mentioned earlier.
Yeah, and I think one of the questions I'm seeing here is about winners and losers with the recovery, and that demographics, technology, aging, all of these create unique dynamics where we actually may be seeing in this recovery that the winners remain winners and the losers remain losers. How can the Fed hope to address these dynamics? Is there a unique role for fiscal, regulatory, or other government policies to perhaps address these dynamics?
Well, we can help, but clearly, this is not something that monetary and policy and supervision of banks and financial stability and payments can do all by itself. Those are the jobs that we have. Clearly, we have, and we've said this from the beginning, this will be a work of all of government, in the first instance from the health authorities, but then from fiscal authorities. And I wouldn't be, if you just look back to February of this year, it's only been 8 months. And we had wages going up the most for people at the lower end of the wage spectrum. We had labor force participation moving up against all the predictions that if you'd gone back a decade and said what'll be happening with U.S. labor force participation, nobody thought that labor force participation would still be meaningfully above 63%. And yet here we were at 63.4%. So anyway, I'm optimistic that I'm very optimistic that we can get back to that. But it will take a concerted and continuing effort, I think, from policymakers to get us through, particularly this next phase. While the expansion is ongoing, it's still moving at a pretty good clip, and I just think it's important that we stay at it.
Wonderful. Some in my industry have described the decision of the Fed to intervene in markets through purchases of investment-grade bonds, as well as the traditional MBS and Treasury assets that we saw during the global financial crisis, as the Fed moving from being the referee on the field to a player on the field. And can you describe how the Fed plans to move back to its traditional role as referee? And are there downsides of the Fed being the player on the field?
Well, so let me go back to the beginning. As this began to unfold and as it became clear what was getting ready to happen and the likelihood of a shutdown and the great unknown about what that would mean and the fact that it was happening globally, we came to the view, my colleagues and I came to the view pretty quickly that we needed to use all of our tools and needed to do so in maybe ways that where there had been red lines saying we won't cross these red lines. And there I'm thinking particularly of the lending to corporates and to state and local governments. And I don't know how I would have been able to explain to the public that we didn't go to the limit of what we could do. I just thought we have to do this. We're going to do this. And we did. So we took those roles on in this historically unique situation. And I think, history will judge how well we did, but we did it. And I have never regretted the fact that we did that. And we knew from the very beginning that there was going to be a time to put away those tools. That time is not here, but when that time comes, we will put them away. And there will also be issues around expectations that we now have these new tools and we can use them all the time for different things. And that's going to have to be something that we work on as well, because we don't want the Fed, no one should want the Fed to be intervening in markets on a routine basis like this. This was really we hope, once in a lifetime situation. So, we're determined to, first of all, we're going to keep at it until we are very far along and sure that we're out of the woods here. We're in no hurry to stop doing what we're doing. But when the time does come, we will put these away. And we're not looking to find ways to keep them in place and take on new and different roles. These are really emergency tools. And when the emergency is well and truly behind us, and we're highly confident of that, we want to put them away under lock and key. And we'll use them again if we have to, but not on an ongoing basis.
So one of the questions here refers back to your speech, as well as President Evans' speech on the word and when you talked about how long we should expect a near zero Fed funds rate, we should expect maximum employment and inflation moderately exceeding 2%. And so this is from Robert Dye. And he says, that sounds like lower for much longer. Is that the message? Which I think I know what the answer is, but I just thought I would ask specifically.
Well, I hope that our guidance the guidance that we issued was clear. And what it said was that we have longer term goals, which are to achieve average inflation and inflation expectations anchored at 2%. And we would remain and we said we wanted to have an overshoot because we'd had a long undershoot. And until we do those things, we'll keep policy accommodative, we said. At the same time, we said we would keep policy at the current level until really three things happen. One, labor market conditions are consistent with the committee's estimates of maximum employment. Two, inflation has reached 2%. And three, inflation is on track to move moderately above 2% for some time. So that's, and you know, the thing is, that's not a time-based commitment. That is an outcome-based commitment. And I think that's really one of the nice features of it, is that if the economy proves much faster, recovers much faster than we expect, that'll be great. And you know, this guidance will work in a whole different range of possible outcomes, a vast possible array of outcomes. And if it's slower, then we'll be at the lower bound longer. So that's really what it's meant to accomplish.
Yeah, yeah. I have a couple of questions in here about the implications of running inflation at a hotter pace for folks who are on fixed incomes, the elderly, the distributional effects may be somewhat more negative for folks who are on fixed incomes. Any thoughts on some of these sort of perhaps downside effects from the policy?
Yes, so monetary policy is famously a blunt instrument, and I would just point to look at the last recovery. We managed to get to 3.5% unemployment and stay pretty bouncing around between 3.5% and 4% for 2 years. That had enormous benefits for low and moderate income communities, for people at the margins of the economy. Participation moved up. It had great societal benefits. Now, so low interest rates do work to support economic activity, and I think we believe that, and that seems to be the case. It's not that every single person will benefit, and although if you own a home, or if you own other financial assets, or if you have children who want jobs, lots of people will benefit from low interest rates and a stronger economy. And of course, our assignment from Congress is maximum employment and stable prices. That's what we're supposed to use our tools to accomplish.
So I think I ask you this every year, and I will ask you again. And it always helps to get clarity on this point. Just recently, the San Francisco Fed wrote a research piece on the effects of negative interest rates in other economies and the banking systems there, and the willingness of banks to lend and extend credit. And those negative rates they found did create a negative impulse out of the banking system into the real economies of those countries. And so for the United States here, the Federal Reserve, what are your thoughts on negative rates?
So really nothing has changed since the last 2 years on that. So it's just negative rates are not a tool that we see as something that we're looking to use. And it's really two things. One is that we have tools that we think served us well and will continue to serve us well. And the second is as you just said, the evidence on negative rates is sort of mixed. There is the effect on financial intermediation. There may be also a positive effect to the extent using negative policy rates causes rates that face the public to move down lower. There's probably a positive effect there, but since it's not clear, and since we feel like we have, policies, likely at full employment, we will again have policy space on rates. And I think we understand asset purchases better and better. So I think we have the tools that we need.
Wonderful. During the GFC, there was quite a bit of coordination across the global central banks. It was much more of a financial leverage type of crisis than the COVID crisis. But perhaps you can spend a couple of minutes discussing how you've been coordinating with other central banks in response to the COVID crisis.
Sure. So there's a lot of communication all the time between central banks, both at the staff level and including me with my peers, and informally. There's also we have regular meetings every 2 months in Basel, and although currently we do those, of course, not in Basel, but on a group call. So there's a lot of communication going on. I'd say when this crisis broke, I would point to a couple of things. First, the swap lines. With ultimately, I guess, 14 different countries. So that was international coordination. There was one difference this time, though, which is that in the global financial crisis, more central banks had room to cut rates. meaningfully cut rates. So, and we were the only, we had easily the most policy space to do that, which we did very quickly at the beginning. But so there didn't need to be a lot of coordination on that because, other central banks, important central banks were already at negative rates or very low. So, but I would just say the coordination is essential and it's ongoing. And, I think because we are, we're independent, we're not part of the governments, we have a very collaborative and constructive relationship with each other and a lot of communication, and that's a healthy thing.
Great. So I'm seeing two questions that are essentially about the interplay between the Fed's new policy and the capital markets, and I'll ask you both questions, and they're basically the opposite scenarios. So the first scenario is X number of years down the road, we still have not met the Fed's new policy objectives, and at the same time, we see serious asset bubbles. What should or could the Fed do to respond to this? The obverse is basically, let's call it X number of years down the road, and the Fed's hitting its objective, and inflation and unemployment are within the target as stated by the Fed, but asset markets are down considerably. How should the Fed respond? So it's basically the same question with two opposite scenarios.
Okay, so the first one, so we said we say in our new consensus statement that, I'll just read this, that sustainably achieving our goals depends on a stable financial system. Therefore, the committee's policy decisions reflect its longer run goals, medium-term outlook, and assessments of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. We also had there's a statement in our post-meeting statement that notes that we'd be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Now, one of those risks could be financial stability, but I would look at it more as kind of a humility clause. We know that the economy can react in surprising and unexpected ways. Witness 2020. And so we say explicitly in our statement that, again, if risks emerge that could impede the attainment of the committee's goals, then we can respond that way. Now, I would also have to add that I don't think, and we don't think of monetary policy as the first round of defense on financial stability. That really is a job for capital, liquidity, risk management, all of the things that the banks do so much better now. That's really the stress testing, all the things that we do. That's really the first line of defense against financial instability, is just having a really strong and robust financial system that's resilient to the things that can happen in the financial system. So we haven't historically, we always, clearly we are considering financial conditions in the decisions that we make, but we have generally not, I don't know of a case in which we've ultimately decided to take an action because of financial instability, but it's something, it's in theory, it's possible. The second one, if I understood, I'm not sure I totally understood the second. So we're doing everything right, but asset prices are low?
Yes. So the economy is booming, inflation is at target, unemployment, we're at full employment, but the stock market, let's say, is in the doldrums and is down. Should the Fed worry?
That's a really easy question. Our job is maximum employment, price stability. That's our job. If you give me maximum employment and price stability, then those are the things that we're focused on. We're obviously not focused on. We monitor financial conditions, but we're not focused on the price of any particular asset really ever. It's about broad financial conditions, and ultimately it's about the real economy. If the real economy is in great shape, then that's where we want to be.
Yeah. So in your talk today and in previous talks over the last several months, you've spoken quite a bit about the distribution of gains into the economy have varied based on who you are. And here I have a question about the current situation, where they ask, what impact do you expect to see on economic growth and employment as a result of a homeschooling environment which requires women to either drop out of the workforce or work less? So that's a little more specific than typical, but curious on your thoughts.
Right. So, I mean, as I mentioned, this episode, this pandemic and the economic fallout from it are very challenging from the standpoint of issues of income and wealth equality and just basic fairness. And that, in essence, the part of the economy that's been hit the hardest is those people who are on the front line in service industries. That skews to women, it skews to minorities. And when even 8 months ago, we were able for the first time in a really long time to have some good news on distributional issues. Now this comes. So it's something we've been calling this out since the very beginning. We've really got to work hard to counteract this. Now you mentioned, and we did see, you mentioned women and homeschooling, and you see the labor force participation among women dropping as the school year starts. And, it depends on how long it lasts. So I would just say, if ideally we'll get through this, we'll have a vaccine, we'll have, sooner rather than later, we'll have something that will enable people to go back to their lives and make the choices that they want to make and not have them forced on them by this pandemic. And I certainly hope that's the case. The longer it goes on, the more likely there is some lasting damage. We hope it's not too much. And frankly, it's not great for children either. I mean, someone told me the other day, there's no online preschool. And, so for many people, and it's a lot of women, it's winding up being in the home with young children who really should be in school, and you would much prefer to be working. So it's a real issue.
All right. So the pre-GSE model, before the financial crisis, has often been criticized as a system of privatization of profits and socialization of risks. Some would describe capitalism as a system that allows owners to take risk with the expectation of return should their investments, ideas, and process bear fruit. A key component of this system has been tail risk, both to the upside and downside. If the Fed and fiscal authorities scramble to save capital holders from taking losses when a tail risk arises, are you concerned that the elimination or minimization of the Schumpeterian process in our economic system may actually increase the risk of secular stagnation, the exact scenario that monetary and fiscal authorities are trying to avoid?
So I think that's a very legitimate concern. And I do believe that, under our system, one should be able to reap the benefits of success and should have to bear the costs of economic non-success. So I think that's all right. And I think, that doesn't change. I wouldn't change what we did, though. I mean, I think we did what we did because of the people that we serve, in particular, the people who've lost their jobs and now are trying to find their way back into, a profitable economic life, a positive economic life. So I guess the best thing we can do to ward off the concerns that this questioner raises, I think, is to now go back over what happened, just as we did after the financial crisis. And we're doing this. Go back over and look at the places that really are there places where we can fix things so that they would be more resilient to this kind of a shock. And that, by the way, that would also include, things we can do to be better prepared for a pandemic. Right, because obviously that's now a possible thing, and we can, if it happens again, we hope not, but if it does, hopefully we can be better prepared on that front. We can also look at things that happen in the financial markets and in the economy and make them more robust to episodes like this. And in this case, it's not because it's not this didn't happen because of moral hazard. The moral hazard is more that we don't want people to assume that we'll run in all the time. We want to reserve these things for truly unusual and exigent circumstances. So very legitimate concerns. I think the time to address them is, when we're well and truly back on a solid footing, unemployment is much lower, and economic activity is going on. People are going back to work. And then I think that's really time to be ready to maybe make some changes in regulation. We'll see. I mean, we'll see what comes out of the analysis. We're actually working on it right now, as others are around the world.
All right, wonderful. So many wonderful questions still in the queue, and I apologize to everyone who we didn't get to address their questions. But I want to thank Chair Powell again for joining us again at the annual Nave meeting, and we wish you and the Federal Reserve the best of luck and success in all of the policies that you've initiated over the last several months, and certainly for the U.S. economy, that we continue on this positive path.
Thank you, Lisa. Thanks to everybody.
Thank you.